Hello. Today we're going to be talking about accounts receivable and how to book them, the gross versus net method. First, let's just start with talking about what is a receivable. A receivable represents a claim to a future collection of cash and other assets or services. So basically, an accounts receivable occurs from the sale of goods or services on account. So it's when your customer or client doesn't have cash to pay, then they put it on credit, on account. You send them an invoice, and then they will send you the money whenever the invoice is due. There are things called so those are called accounts receivable. Non-trade receivables are the same thing. They also result from a service on account, but it's for items that are not central to your business, such as if you have a tax refund claim, or an interest receivable because you've lent out money or advances to employees. But in this video, we'll be talking about accounts receivable or trade receivable, also called credit sales. And like I said, so accounts receivable occur when you have a sale on credit. We establish the accounts receivable when we recognize revenue. And revenue recognition is going to be discussed in a different chapter, but basically we recognize revenue when it's earned, not when we actually receive the cash. And this is key, that we recognize revenue at the amount that we expect to receive. So when we book accounts receivable, it's basically an informal credit arrangement with your customer, saying that you're going to pay us back within 30 to 60 days after the sale, and therefore it is classified as a current asset on the balance sheet. And we say informal credit arrangement because there's no actual written contract like you would if you're loaning money to someone and they have a contract that they would sign. Let's talk about discounts and how we record accounts receivable when we have a discount. There's two types of discounts. The first one is trade discount, and that's really just when the corporation gives a percentage reduction from the list price. So if I say, oh, you can have a 10% discount right off the bat, and I sell you $100 worth of goods, and I say you can have 10% off, so you only owe me $90, my receivable would be recorded at $90. There's also a sales discount, and that's what we're going to be talking about in this video, our sales discounts. And sales discounts are incentives for your customer to pay their invoice early. And it's a reduction in the amount that they owe you if they pay the invoice within a specified time. And usually it's a shorter time than when the invoice is actually due. So when you see on an invoice, there's going to be invoice terms 2/10 and 30. That means you're going to get a 2% discount if you pay within 10 days of receiving the invoice. Otherwise, the full payment is due in 30 days. And there's two ways to record the receivable when you have these sales discounts, the gross method and the net method. So let's read this problem because it's going to go through several slides. And it says the Hawthorne Manufacturing Company offers credit customer a 2% sales discount if the sales price is paid within 10 days. Any amounts not paid within 10 days are due in 30 days. These payment terms are stated 2/10 and 30. So on October 5th, Hawthorne sold merchandise at a price of $20,000. I'm going to put on here on credit because that's the whole point of this video. So if you do the gross method, you record your receivable for the full amount of the sale. So we sold merchandise at 20,000. We debit accounts receivable 20,000 and credit our sales revenue 20,000. If you record it using the net method, you are assuming that your customer is going to take advantage of this discount, pay this invoice within the 10 days, and therefore receive the 2% discount, at which point they only owe you 19,600. So you record your accounts receivable in 19.6 and your revenue in 19.6. Okay. The problem goes on to say the same problem. It says the customer paid $13,720, which is $14,000 less the 2% sales discount on October 14th, and then they paid the remaining on November 4th when the invoice was actually due. So they didn't, so the invoice, remember the invoice was for $20,000 total, but they only paid a portion of it to, within the 10 days. So they only received the 2% discount for the portion they paid. So they say for $14,000, we were paying early. So under the gross method, let's go back to the previous slide. Under the gross method, we booked the accounts receivable was for the full price, the $20,000, which includes the $14,000 plus the $6,000 that they still owe. We are going to credit the accounts receivable for the full $14,000. We are not going to account for the discount in our credit. We received cash of $13,720. That's just how much we got. And then, so obviously our entry does not balance, and our sales, we debit this new account called sales discount for the plug. And this is a contra account. It's a contra sales revenue account. So this sales discount, when you look at your sales account, you would reduce it by this sales discount amount. Under the net method, because we already recorded the entire, when we made the sale for $20,000, we recorded it at the net amount of 2%. Our accounts receivable is already discounted at the 2%. So we're just going to credit the accounts receivable that we have at $13,720, and we still receive cash for $13,720. Moving forward to November 4th, the customer has paid the remaining balance of $6,000. So the $6,000 has no discount incorporated into it because we paid it after the 10 days. So under the gross method and the net method, we receive $6,000 cash. So we debit cash for either method. Under the gross method, our accounts receivable, we had booked the accounts receivable at the full $20,000, which did not include the 2% discount. And this cash does not have a 2% discount. So we're gonna, all we need to do is we need to credit accounts receivable and debit cash. That's our entire entry. And so when you look at the T accounts for accounts receivable for the gross method, it goes over different slides. But initially we booked 20,000, and then the previous slide we credited 14,000, right? Because they paid $14,000 early, minus 2%, and we credited 6,000 here. So our accounts receivable zeroes out. When we booked that 14,000, we have to book, in the previous slide, we booked a credit for $14,000 because that's kind of what we initially booked our accounts receivable at. We booked at the gross amount. And that's why we had that sales discount amount in the previous slide. When we look at the net method, right, we received our cash at 6,000, and our accounts receivable was recorded at 98%. It already included the 2% discount. So we have to credit our accounts receivable at what it was recorded at. And now our entry is out of balance. And so we're going to have this credit, which is a plug called sales discount forfeited. And that also goes against your, well, not against your sales, but it's also it's a sales account, although not part of your regular sales. And it's a sales account because we received more income, right, than we were expecting. Let's quickly just, I'm going to erase this really quickly up here just so I have more room. But let me go over the net amount, the accounts receivable for the net amount. Let's just follow that through. Initially, when we booked the accounts receivable for the net amount, we booked it, we booked it at 19,600 because that included the 2% discount. This is, by the way, I'm doing the net amount, the net method. In the previous slide, when they paid a portion of it early and took advantage of that discount, we credited accounts receivable 13,720. So we credited 13,720. And that leaves us a balance of 5880. So when we pay the rest of it off outside the discount period, we have to credit whatever is remaining, right? So we have to zero out our accounts receivable because we are not owed that money anymore. So under the net method, you have to credit your accounts receivable what it's booked at, which was the 5880, and the plug is to this sales discount forfeited. And let's just show, and this is just showing the presentation of the gross versus net. In the gross method, we booked revenue for 20,000, and the other side was the accounts receivable. The client took advantage of only a portion of the invoice. They paid $14,000. They paid early, so they got 2% discount. So they got $280 sales discount. This is NA for basically for the gross method. And net sales revenue is $19,720. In the net method, we originally booked our accounts receivable and corresponding sales revenue at assuming the client takes the full discount, we'll take advantage of it at $19,600. However, they only took advantage of it for $14,000 of the total invoice, or which we booked at $13,720. But so they forfeited the discount by $120. So we reduced our sales by that much, and we increased our sales by that much, and then therefore our net sales revenue is $19,720. So which way is correct? They're both correct. However, by recording it the net method, it just better reflects the amount, the sales amount and your balance sheet more properly, because the discount is more representative as to what probably will happen. Because if this customer can take advantage of the 2% discount, they will. 2% discount doesn't sound like a lot of money, right? But just remember that 2% discount was just for paying it 20 days early, right? So instead of paying within 30 days, you can pay within 10 days and get that 2% discount. And so if you're gonna say you have $100, right? And you pay it early by 10 days, you pay it within the 10 days, so you're paying $98. So really it's like you're paying, or you're investing $98 to earn $2, which doesn't seem like a big deal. However, because this return is only for paying it 20 days. So you're getting this 2% return for 20 days. And when you convert that to an annual effective rate, it converts to 37.23%. So it's like investing $98. If you invest in $98 and got an annual return of 37%, people, almost anyone, if they could afford it, would definitely make that investment. So to the extent that the buyer can afford to pay that invoice early, they probably would. And therefore, the net method is just a better reflection of what's going to happen.